Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra and this is Market Today, a show where we'll help you understand all the latest news from the stock markets and also the way the benchmark indices are trading in trade right now in terms of the sectors and the stocks. So where is the most buzzing action being seen, and also how are experts really viewing the market setup as of now, and what are they recommending as investor strategy? All of that will be the focus of this discussion on the show. But first up, a quick check of how the markets are doing, especially the benchmark indices, the Nifty and the Sensex at this point. If you look at the Nifty 50 right now, there's a cut of almost 121 odd points. It's hovering near 17,735. About 0.7% of a cut is being seen on the Nifty pack. Similarly, on the Sensex, it's down by 400 points almost at this point in time, halfway through the mark, and 0.6% of a decline is what you can spot right there. So market definitely drifting towards the lower point of the day. In terms of the broader markets, there's a deeper cut that you can spot, 1.3% of a fall for both the mid-cap 100 and the small-cap 100 indices as of now. So where is the pressure really emerging in from? Well, it's all across. You can look at the Nifty bank right there. It's seeing a cut of 0.8%, especially with the PSU banks. That's dragging the most up, almost 2.5% in trade today. That's the weakest link in the markets today. All the sectors of the Nifty are down in the red, led by losses in the PSU banks, and then there is a sharp fall in the IT pack as well. Remember, the IT stocks have been showing some smart recovery and bounce in the last week itself, but this week it's off to a lower start, about 2% lower for this one. 1% cut for the realty space. That continues to be a drag on this markets. Apart from this, there you can spot cuts on autos, FMCG, even pharma indices for that matter, about 0.7, 0.8% of a decline right there. The market breadth clearly favoring the declines at this point, 37 declines to 13 advances at this point in time. In terms of the biggest losers, you're again seeing pressure coming in on the Adani Group of stocks, of course, after that Moody's downgrade, and also, Adani Group's own growth targets that they have reduced as well. So 7% cut on Adani Enterprises right ahead of its Q3 numbers. Adani Ports is also seeing a cut of over 5% today. SBI, Infosys, Bajaj Finance, the other laggards at this point in time in terms of the Nifty 50 stocks. Top 5 are gainers at this point, all those stocks that are buoying the sentiment despite the overall subdued move. You can see Titan is hovering higher, 1.9% uptick. L&T, Bajaj Auto, Eicher Motors, so far and few between. Some of those automakers, especially from the two-wheeler pack, showing some kind of bounce today. And NTPC about 1% up in trade. Time now to welcome our guest for the day. Abhishek Basumallick joins in. He's the founder of Intelsense Capital. Welcome, Abhishek, and thank you so much for taking the time out for this discussion. Well, another week to start off with. What's the sense that you're getting? Of course, the markets have begun this week on a muted note. There is an overhang of the Adani Group developments that we are looking at continuously, despite some kind of bounce that we witnessed last week. Again, there are some pressure points getting created. And on the macro front, of course, we are awaiting the retail data numbers, the IIP data, and then the US inflation numbers as well. How does one really approach the markets in this new week amid all of these news developments?
First of all, thanks for having me on the show. And I think it's like we discussed last week. I think we are in a range, and unless we either take out, either the upper end or the lower end of the range decisively, the markets can consolidate and be in this range for a fairly long period. In fact, now that most of the earning season is also done with, the trigger, all the trigger points have actually sort of gone, right? So you had the budget, you had earnings, so all of that, you have the RBI monetary policy, all of that is now behind us. So new triggers is not anywhere there in the horizon right now. So there's a possibility that the market is going to sort of be lackluster and go up 1 or 2%, come back 1 or 2%, and pretty much remain in this kind of a range for some time.
Okay. In terms of several pockets, we will come to each pocket. Banks, ITs, all of them are showing decline today. But, what picked up slight sentiment from the last week was the new age tech stocks, that became suddenly active over the last week, of course, amid some of the earnings that started to come about. Even today, we are seeing reaction of some of the, companies' earnings like Paytm, Delivery, Zomato, all of their scorecards have come up, although the net loss for some has narrowed, for some Even for a stock like Paytm, we did see the EBITDA positive really coming about. 197 communications, so that stock was in focus. Zomato, if you see, there's a revenue that's uptick of 75%, but definitely there are some concerns. Then that's where the stock is down in trade. In terms of delivery, the net loss has come in at 195 crores, so that's expanded. So it's different for different companies. But overall, I wanted to take your sense on the new age tech stocks as to what are you sensing. Is your conviction really building up on some of these stocks, looking at the tonality that's changed from the management, looking at some of the kind of hard work that they want to do and come into profitability pretty fast, and that's the kind of sentiment they want to garner for their own companies and investors. How are you looking at the current developments right here?
So I think we should not really uh, demarcate businesses as new age, old age, and etc. We have to look at them individually as businesses, and if
Correct.
those businesses merit, they are profitable, or they are on path to profitability, they have a good business model, they have a longevity in their business, then they will do well. Now, what is in my mind, I think what is happening right now is, in a lot of these kinds of stocks, is they've been beaten down a lot, and now people are starting to see that, okay, if this is down so much, it's not falling further, so maybe it's a good time to get in and get maybe a 10-15% whatever upside to it. Now, that may be a decent strategy for the short term, but in the long term, you really need to understand, the quality of the business, how it is going to become profitable, how soon it is going to become profitable, and not only it's just not only a matter of profitability, but it is also a matter of how sustainable that profit is, what the margins are
Correct.
going to be. A lot of those points needs to be thought about.
Yeah. So tell me, how should one really be approaching some of these stocks? Are any of them at this point in time starting to look a bit more promising at these valuations? Can one still look at building up on some of the stocks or take positions, fresh
See, I think
positions in? Yeah.
so. I think out of the businesses that are there, I think the only one that sort of interests me is Zomato,
Okay.
because
Yeah.
that is the one where it's actually a good business, and it's difficult to replicate that business. Tomorrow, if you want to start a similar business, it's not going to be easy. Compare that with some of the other businesses, where there are a lot more competitors, and it's cutthroat, kind of an environment in the other spaces. Whereas Zomato, there's pretty much only one major competitor,
Okay.
and they have assets, on the assets, as in not financial asset, but physical. They have people, they have tie up with restaurants, they have delivery executives on the ground, so replicating all of that is not easy.
Hmm.
Now, the
Hmm. Hmm.
point of contention is, what is the valuation that you want to pay for it? Now, that's the main question, or that's the main debate that people might have.
Sure.
uh, and I would still want to, sort of wait till the time when all these adjustments to EBITDA and PAT and all of that go away. Uh,
Correct.
because if it goes away, and if they are able to showcase that there is a definite market of people who are willing to pay for their services, then the runway can be very long. So I'm ready
Hmm.
to wait for, a few quarters, maybe even a few years, uh, to get the call right, rather than
Okay.
jump in and then try to figure out what went wrong.
Fair enough, fair enough. Noted that, Abhishek. Also, the other point, of course, we are not completely away from the Adani Group of news developments. And today also the markets are reacting, and are punishing the stocks even further, despite the bounce that we had seen last week. After one, Moody's downgraded 4 of the stocks. And then again, after that, the group themselves have cut the growth target and capex in the post-Hindenburg repair moves as well. So they have halved the revenue growth target. There are plans to hold off fresh capital expenditure, and that's the news flow that is coming in. And the group will now shoot for a revenue growth of 15 to 20%, at least for the next financial year, down from the 40% growth originally that was targeted. And this is as per the news reports that we've been getting in. Now, how are you looking at these fresh developments? Does it, still, gives more weight to the fact that there is still time for the dust to get settled down completely, and therefore one should not really hurry into buying these perhaps looking attractive valuations and get into the stocks right now? What would your thought be?
So two parts, or maybe more than two parts, and maybe you have to excuse me for a longish answer for
No,
this
not
one.
at all. Tell me.
Okay, so the first part here is, let's look at the business, and I think we discussed this last time as well.
Yeah.
Is the fallout of this Hindenburg report and all of what has happened over the last couple of weeks is that the debt fueled growth is now going to have a serious challenge. Now, what that means is purely in terms of financial numbers. The Adani Group companies are going to find it difficult to, one, raise money, and second, get that growth in place. Now, that implies that the valuations that one should give it will also need to reduce, because a large part of the valuation that was proposed was simply because of the rate of growth that it was growing. Now, once the growth comes down, obviously what happens is your valuation that you want to give would be much lower. So that's the first part. The second part is, you asked about the foreign banks and brokerages and ratings agencies. So
Yeah.
what is happening again is similar. Like, it's they also understand that capex will come down. They also understand that deleveraging of the balance sheet will now take longer. So that obviously is going to impact their ratings. That is going to impact their valuations, etc. So all these are sort of these are all complementary things that are happening now. That is the main 2 points. The last point I want to sort of make is that I have a feeling that the market has or is moving beyond the Adani Group of stocks. So what
Okay.
it
Okay.
tends to happen, right? What tends to happen is that after a big news, good or bad, comes in, and the market gets time to digest it, and we've now seen probably 2.5, 3 weeks has gone by. Market has probably now digested the news that, okay, this is the new reality. So increasingly you will see that other than what ups and downs that is happening in the Adani stocks, the rest of the market is going to behave completely normally and completely disconnected from the Adani Group of stocks is doing, right? So these are the three things that I wanted to just share.
Sure, sure, sure. Fair enough point right there. And I hope all the viewers are noting all of these points. If you are interested in the Adani Group of developments, do definitely do your own checks and balances and read through the expert comments. And Abhishek has given you quite a bit of insight right there as well. Let's move on then. Since you said the markets are slowly moving on, let's also move on from the Adani Group of stocks. And you said that, markets may be remaining in a tight range as of now till the time we do get any fresh triggers emerging. But then what is the best way to approach these markets, and where does one really look for profits in this kind of a market, and which are the pockets one should target?
So different time frames will have to address this kind of a market different. So if you
Yeah.
have a 1 year plus kind of a time frame, I think very good time to keep accumulating stocks. You look at infrastructure, railways, engineering, capital goods, banking. All of these are looking extremely good. You can keep accumulating the stocks that you have identified that look good to you, and keep accumulating those. So that's the view for the slightly longer period. Now, if you have a shorter time frame, if you're a trader, then you need to look for stocks which are more volatile and then play that cycle. And that's a very difficult game to play, because you might get whipsawed on both the sides.
Okay, understood that. Well, thank you so much, Abhishek, for being with us and discussing with us various pockets in the markets and how do investors really approach the markets at this point in time, given a lot of clarity on the numbers as well and on the new age stocks and on Adani Group development. So thank you so much for that. Let's quickly look at how the markets are trading at this point before we wind down the show. About 0.7% of a cut still on the Nifty and the Sensex. So it is a dull day and a subdued trade kind of a day. But if anything really moves in the second half is what we'll have to keep an eye out on. Although a lot of overhang coming in from the macro parameters, maybe the markets will be looking at some clear direction from that as well. And we'll keep an eye out on all of that and help you understand every which way that the markets may be impacted in terms of the news flow. So do stay tuned on to with us on Business Today TV. And also, you can continuously stay engaging with us via all social media platforms, Facebook, Twitter, LinkedIn, and Instagram. So see you there as well. Many thanks for tuning in for now.
Well, the biggest challenge in the global movement to 100% renewables today is how we balance